Thank you, as we do every month, for joining us for this December knowledge series. We debated whether or not to stuff your virtual mailbox with another event, but we'll make this quick and hopefully informative. And in most cases, with the exception of last month when we gave people access to how to travel to Europe, discussion about Roth, discussion about an investment strategy, what have you, is a personal thing. And so we would expect that if you would like to follow up with any of this information to see how it applies to you, that we would do that personally. And you can just reach out to Dave to make that happen. Today's discussion is about Roth conversions and Roth contributions in general. And the reason why we're talking about it when so many other people are is that very few people feel that they understand the subject matter well enough to know whether that they're doing all that they can to maximize the benefits of Roth assets. And part of the reason why is because it's very subjective. It's the calculation as to whether to do a Roth or not do a Roth conversion is less formulaic than one would think. Although, just to go against that comment, we actually have a calculation to methodology to show you today. So our goal is to try to demystify all the clutter that surrounds Roth conversions and Roth contributions. And we hope that in doing so, you'll have the opportunity to do something that brings more tax-free assets into your life. So I'm just going to get into our presentation. Roth conversions and contributions to Roth or not to Roth, that is the question. All right. So why do we want to consider Roth conversions and contributions at all? Well, these are common elements. They're common elements. And by the way, just before we get into it, the reason why I use the common elements is because, in my view, the benefits to Roth and Roth conversions are different for the younger set than they are for the older set. And yet, even though I feel that there are different motivations and justifications for the younger wage earners versus the older wage earners, there are common elements that are shared across all Roth decisions. So why would each of us or any of us consider Roth conversions and contributions? Well, number one, we want to create maximum tax efficiency over our lifetimes. Now, I happen to know that we have with us a talented CPA, and I won't name the person, but I'm gonna, without stepping on his feet, I would say we all are levered because we go through this annual rite of passage of filling out our tax returns. And many of us do it with the assistance of a tax expert, a CPA, or an enrolled agent, or what have you. And we're levered, predisposed to wanting to save taxes right now. At any given time, every April, we don't want to be writing that check out to the IRS. But doing it that way, focusing only on pre-tax deductions for the here and now, does not necessarily mean that we are maximizing our lifetime tax efficiency. And Roth IRAs and Roth conversions will help us create lifetime tax efficiency. Reason number two may be to facilitate a more tax efficient wealth transfer to our children, to the next generation. And we'll get into why that is. And believe it or not, I guess that's a silly thing to say. Indeed, there are individuals whose balance sheets are so well developed that they can target their Roth assets as a generational gifting opportunity not necessarily a current spending vehicle. So we'll tackle that. And then the third and more subtle reason is that focusing more on income coming from Roth assets. You see, the third reason to consider Roth conversions is to reduce the chance for unintended negative consequences related to the costs of Medicare and Social Security. So we'll naturally tackle that. So the decision to execute a Roth conversion or not is complicated. And the reason why is because the true calculation, the accurate calculation of a Roth conversion break-even calculation, it involves many inputs that are unknown at this time. You know, if you go through, hopefully you won't do this because you have a more exciting life than I, but you won't sit and listen to 20 different YouTube pieces on Roth conversions like I do. But they all start with assuming tax rates are higher in the future, assuming personal tax rates are higher in the future, assuming that they remove certain deductions, assuming that the stock market will or will not be as productive over the next 20 years. These are all variables. We don't know that it's going to happen. In current time, even if Joe Biden and his economic team submit a bill to significantly jack personal tax rates, given the obstructionism in DC, what's the chance that something like that would pass? So there's so many unknowns, it makes the perfect Roth calculation difficult. But what we've come to understand in seeing the full financial planning picture, to see the effects and the ramifications of Roth conversions in action with our retired clients, we understand often that the decision to go Roth will come down to factors that are not purely mathematical. They'll rest more on things like, how are you going to use the money? When will you use the money? How generous do you want to be to the next generation? Do you want to preserve estate capital, or do you want to deplete all your assets? Are you one of those people that would like to move to heaven having spent down your last nickel and let your children fend for themselves? And these are not mathematical considerations. They're life use, financial planning, value-oriented decisions. So, but again, the number one bullet point here, why consider Roths? Well, because you want to create tax efficiency over your lifetime. Okay, stop with that. Now, regardless of what your personal strategy, what your personal motivation is for Roth or Roth conversions, what common elements should be in place to give the green light to any Roth commitment? Well, number one, and you probably all heard this before, in our view, you really have to have liquid and discretionary after-tax assets or liquid securities to pay for the taxes that are owed as the result of a conversion. So where does that money come from? Comes from saving well and having more than you need. It comes from a windfall. We have clients who get stock grants when they leave their employer, and they use some of that money to do a Roth conversion. We have clients who get an inheritance and use some of that money for a Roth conversion. We have some clients who get a huge tax refund and use some of that for the following year for Roth conversion. We have clients who just have saved so well and have grown their assets so well that they have excess cash that they want to use for their Roth conversion. So it's been beaten into most people, but we still see it, that you don't want to convert traditional retirement assets to a Roth, create a tax liability, and then liquidate more of that IRA to pay the tax liability. That would be a series of events that you wouldn't recover from. So number one, you have to have liquid and discretionary cash reserves or other assets that are can be monetized to pay for the taxes externally. And as you'll see later on, one of the cool strategies that people will often do is they'll do Roth conversions right away in January. So if you do a Roth conversion the first week of January, you may not have to pay the taxes till the following April. So you have like 14 months, 14, 15 months to grow the money elsewhere or do something phenomenal with the Roth conversion investment strategy, but we'll get to that. The second common element that has to be in place is that if you're doing Roth conversions, at least in part, you want to base the dollar amount on maximizing your tax brackets. And right now, for whatever reason, and Fred can comment on this later in the show, but we have a couple of very wide tax brackets. And so right now I'm going to see if I can move over to showing you the current tax tables. Okay, so these are the 2021 tax brackets. So if you look here where my cursor is, for married filing jointly, when you get over 20,000, from 20,000 to 81,000, you're only going from a 10 to 12% tax bracket. Here, if you're over 172,000 but under 329,000, you're only going from a 22 to 24% tax bracket. So those brackets are very thin. Well, look over here on the left. There's a bracket that jumps from 12% to 22. If you're over 81,000, you jump from a 12% to a 22% bracket. That's 10 percentage points. And similarly, in the next level, over 329,000, but up to 418,000, you jump from a 24% bracket to a 32% bracket. So if I know, let's say we're doing this Roth conversion calculation, more towards early December of a particular year, so that you kind of know what your tax picture is. And you're going to come in around 330,000 between you and your spouse. Well, yeah. So I'm probably missing a step of this ladder. You would just want to sit there and say, okay, if I'm at $100,000, if I'm at $150,000, I don't want to do a Roth conversion that pushes me over 329, because then I'll go up into the 32% tax bracket. So you just make sure that you chunk it, as they call it. You figure out what Roth conversion, when added to your existing adjusted gross income, would come in, so that you're just below that 24% bracket, and you don't find yourself just inadvertently converting a huge amount that kicks you up 8 percentage points in your tax bracket. So back to the bullet points, you've got to be very, or we as advisors have to be very mindful of the tax brackets, and that's called tax bracket maximization. We're doing this now for a client who's literally like, okay, I'm going to come in at X, and the next tax bracket, which is an 8 percentage bump, allows me to do no more than a $50,000 Roth conversion. So we're going to do it at like a $40,000 conversion, just to give him some wiggle room in case he forgot some income or he gets some receivables in right at the end of the year. But it's got to be based on tax brackets. The third element that needs to be present to justify a quality Roth conversion is you have to have enough time to allow the Roth assets to grow. And that might seem self-evident, but sometimes it's not. And you'll allow those Roth assets to grow either because you're young and you know it's going to be 30 years before you hit 59 and a half or 60, or you're closer to retirement age, but you know that that Roth asset can be left to grow and is not needed for current expenses. So Steve Worth, who's on this presentation, has helped us build what we call a retirement income illustrator. And when we run that for our clients, if we realize they can pay their bills plus have some discretionary cash with their Social Security, their IRA withdrawals, income from their after-tax assets, plus a little bit of IRA, but they have another IRA that doesn't need to come into the current budget, that might be a Roth conversion asset because they won't need it anytime soon. The fourth item here, as it says, and this is well known, preferably, you would make the Roth conversion at a time when the equity markets are down during a correction, so that the subsequent rebound and the further growth in the account value now occurs in the tax-free bucket rather than the taxable one. So if you had a $500,000 IRA that got caught in a big market swoon and now it's 400,000, that would be a good time to convert because you'll have less of a tax bite at 400,000. You move it into the Roth, and then the market has its traditional V-shaped rally and then goes higher for the next couple of years. And all that regrowth now happens tax-free instead of becoming a future taxable liability. Now, this, of course, all again presumes that you have the money or the stomach to pay Uncle Sam a check for the tax liability of doing the conversion. So it's not a given that you would do it, but if you are going to do it, preferably you would make that Roth conversion at a time where equity prices are low, so you could leverage that. All right. Now, I mentioned that we have kind of this difference in motivation between young savers and older savers. So for the young savers, and by the way, if you're an older saver and you're joining us tonight, one piece of homework would be to make sure your kids get this message. So pass it on to the kids, grandkids, cousins, whatever. It's a good advice for aunts and uncles and grandparents to pass on to their children. So this is all that needs to be said for a young saver in their 401k or in Roth IRAs. So what does this chart show you? Shows you an example of somebody who's putting away $500 a month into a Roth or into an IRA of any kind, or a 401k, into a tax sheltered retirement account. So interestingly, $5,000 a month, of course, is equivalent to what younger people under the age of 50 can do in their IRA, $6,000 a year. So you're doing $500 a month, you compound that at an 8% return, and you let it grow for 30 years. So what happens? At the end of 30 years, you can see in the graph that the total account value is about $720,000, but your total contributions into the account are only 180. You put in 180, it grew to 720. So that means that you've had $540,000 of account growth. So all you need to ask that young saver is the question you see on the right. So would you rather pay tax on the seeds or pay tax on the harvest? And the answer is you'd rather pay tax on the seed because you're just foregoing the tax savings on 180,000. What's the alternative? Paying full income tax on the entire 720, paying income tax on not only what you put in, but the $540,000 of account growth. No. You want to pay tax on the seed and be tax-free on the harvest. And I stole that. Obviously, I'm not that bright and I'm not a poet, but in one of my 30 YouTube visits over the years, this is the smartest thing I've ever heard someone say about it. Do you want to pay tax on the seed or on the harvest? So this is all we tell younger savers. You know, my son, both my boys, I help them do their taxes. They bitch and moan. They get the taxes done, and then it's in the rear view mirror, and they don't even think about it. So I'm pushing them to do more Roth 401k contributions, because when the rubber meets the road and you got to live off this asset to make it tax-free, you're going to pat yourself on the back for having done so. So this is for younger savers. Now let's move on to slightly older savers. So here's the justification for those of us that are closer to retirement. So number one, after you do the Roth conversion, the assets will be tax-free, assuming that you've had the Roth for 5 years and you're over 59 and a half. And by having that tax-free income, you're going to create a greater level of tax efficiency over the lifetime of those Roth withdrawals. Secondly, if you've got a fair amount of your retirement income stream as tax-free money, then you have a better chance, it's not guaranteed, you have a better chance of keeping your adjusted gross income lower. And that might help to prevent these unwanted IRMA penalties. Is anybody not familiar with anybody heard the acronym IRMA? So IRMA is an acronym, and it stands for Income Modification Adjustment Amounts. I forget the R. Well, income revenue modified adjustment amounts. Basically, what happens for Medicare Part B, which most of us are going to rely on, they have a copay. And at low levels of income, that copay could be $170 a month. But as you have higher and higher taxable income, that monthly copay to Medicare can be as high as $550. So if people have monster IRA, 401k, deferred comp account balances, and it all stays pre-tax, and when you start pulling out the required minimum distributions at age 72, then all of a sudden your taxable income is going to go way up, and unexpectedly, you might find that your Medicare Part B premium goes from $250 to $600. So it might cost you $4,000 or $5,000 more a year just to maintain your Medicare. And there's the same rising schedule for Part D, which is the prescription drugs. It's not as violent, but it's there. So long story short, you want to keep your adjusted gross income lower in retirement to be not only tax efficient, but to make sure you don't get jacked up on the cost of your entitlements that you've been putting money into your whole life. And that begs the third point. Oh, look, I didn't change this to a 4. Whoops. So there's 2 third points. But the first third point is that when you have Roth assets, there are no required minimum distributions. Now, fortunately, the government saw fit to move the RMD date from age 70 and a half up to age 72. But even then, at age 72, it might be as much of a nuisance to have that IRA income as much as it is a help. So if you have Roth assets and now you remove the required minimum distribution, who does that benefit? Well, number one, it benefits people, or it benefits people who would otherwise have more taxable income that is needed to cover current expenses. So somebody has a retirement budget of $120,000 a year before their RMDs come in. Maybe as they get a little older, they want to start traveling before mobility is an issue, and they jack up their retirement budget to 160,000. So they only need another 40,000. But when their RMDs kick in, they're getting 60 or 70,000 of taxable income, and it rises every year, hopefully. So if you're getting $30,000 or $40,000 more from your required minimum distributions than you need, what do you do with that? You tax it and you put it in a side account. And there are a lot of people like, wow, what do I do with that? You can gift it to a charity. You could just spend it. You can give it to loved ones, but you'd rather just preserve it. It benefits, not having RMDs benefits people who have significant after-tax assets from which to draw, and they just want to maintain the retirement funding flexibility to take money from anything at any time as they see fit, and not to have a big tax bill to do so. Thirdly, it benefits people who, let's put it this way, there are a lot of our clients that convert to a Roth for one very specific strategy. So they convert the Roth when they're 65. And they know from personal experience with their own parents that somewhere around age 80, 82, you start to see some problems with mobility. And you know that when you're 88 or something, you might be, you might have to stay local. So from age, I don't know, 80 to 86, you just want to see the world. You want to go up the Rhine on a Vikings tour. You want to go to the Caribbean. You want to travel Europe. So they'll convert a Roth, let it sit in that Roth untouched without any RMDs to really be fully valued around age 80. And then they just give themselves the mother of all retirement raises and start spending the hell out of the Roth money on like a 8-year spend down to really allow them to do the things they want to do in life. So the way I worded it here, it helps those people who want to build a large reserve of tax-free income for kind of a mid-retirement accelerated spending plan. The fourth benefit to the Roth conversion, here coded as 3, is what we referred to earlier about wealth transfer. So there are folks who would like to build tax-free assets to pass to the next generation. So as it is now, you have liquid assets, or you have a house, and either through a revocable trust or your will, that is bequeathed to your children, and then they take ownership, but it takes a year or a year and a half to settle, and all those assets appreciate. So if they want to sell the house or sell the stocks, sell the Amazon, they could do that, but they'll have to pay capital gains tax. If you pass on to your children a traditional IRA, then when they inherit that IRA, they have to pay ordinary income to dump that IRA over a 10-year period. So they're going to get stuck with paying the tax bill that you would have had you stayed alive. So that's very cost prohibitive. So if as a child, as a beneficiary to my parents' IRA, if I inherit a Roth IRA, there are no RMDs to that. It's all still tax-free. And my only requirement is I have to take that tax-free money out over a 10-year period. So passing on Roth assets to your children is a very tax-efficient way to affect the wealth transfer for those clients that feel very strongly that they want to maintain part of their net worth to make sure that their kids do inherit something. So these are the benefits to the Roth conversion for those of us closer to retirement. So let's get down to it. Steve and I, this will be sort of the last thing before we wrap up, trying to stay in our normal time frame. I'm going to show you our Roth calculator. And I promise you that the reason why you're going to see this is not that we're going to go through it line by line. We are not. It's merely to show you that if you really want to get down in the weeds and try to get the best, truest, most complete calculation as to what it would cost you and what the cost benefit is to do a Roth conversion, we've developed our own, thanks to Steve, we developed our own Roth calculator, Roth conversion calculator, and we think it's more true and involved than some of the more sophomoric Roth calculators that you get on certain websites, but we're not going to belabor it. So let me stop this share and go to it. I'm just going to run through an actual example without hopefully having you pull your hair out. So here it is. The Steve Worth invented Roth calculator. We call it the Worthalator. No. Can you see that, Dave?
Yes.
Not that I don't care for everybody to see it. Dave's our. All right. So this is the Roth calculator. I'm just going to run through some of the bullet points and I'll do it quickly. And if it's like flying over your head because I'm poor at explaining these things, don't worry about it. We can do this for you as an individual effort. But right at the top here with my cursor in cell D3, this is a 58-year-old woman. In this model, she's going to do a Roth conversion, but like that example of people who want to create a pot of money to be tax-free in mid-retirement, according to their plan, taking sabbaticals and different things. She probably won't be withdrawing on it until she's 80 years old, and then she's going to spend the heck out of it from 80 through the rest of her life. And if we assume she lives to age 100, she's going to be generating 20 years of tax-free income from this Roth. Her current adjusted gross income is $400,000. So her effective, and with her husband and other deductions and things, her effective federal tax rate is currently 20. Her state tax in Connecticut is 7. So altogether, she's 27% in taxes. If she converts the Roth, it'll probably bring her into the 22% bracket. Later on in retirement, taxes could go up to 25%. So this follows that projection that yes, because the federal government is doing the Build Back Better and infrastructure and entitlements and natural disasters, that we're going to be in deficit and tax rates are going to go up. So this assumes, yes, that tax rates will go up. She currently has a balance in her IRA of $584,000. We're assuming that the rate of return on that IRA is 7%, whether you have it in the pre-tax or the Roth. We're looking at converting $100,000 of Roth. She's got a cash account on the side that generates about 1.5% in a credit union, and she's going to use that cash to pay for the Roth conversion so that the whole 100,000 can stay in her Roth and grow and build. So now we start comparing the traditional to the Roth. So she's converting $100,000. It's going to cost her $28,900 in taxes. The next line item has no value in it. And that is because there are times where if your Roth conversion is too big, it might kick you into a tax bracket that bleeds through and affects all your other income sources as well, which we try to avoid by chunking in that tax bracket maximization thing. But for now, we're assuming there are no other higher tax rates applied to her other source of income. So it's just 28.9 that she has to pay. So her basis on that traditional IRA, the opportunity cost of not leaving it in that pre-tax IRA is 128.9, the amount that got yanked out plus the tax cost. And we compare that against the 100,000 that's going into the Roth. So what does it look like at the end? So when she's age 80, the traditional IRA is going to be worth 505. The Roth IRA is only going to be worth 464, a little bit less. The monthly income from her taxable IRA would have been $3,890, whereas the monthly income from the Roth would be about $3,600. But she pays taxes on her pre-tax IRA. And if she left it there, she'd pay $1,200 of taxes, so that her net monthly income after tax is $2,645, whereas the Roth income stream gets no tax. And so after tax, that's $3,579. That's almost $1,000 a month more per month by having it in the Roth. So her after-tax income in the traditional IRA is $31,700 a year, where in the Roth, it's $43,000 a year. So over the remainder of her life, she's going to pick up $224,000 by having it in the Roth, net of all taxes. That's why we do it. And it's gnarly and dense. But what it tells us is that if you do the Roth conversion, if you pay for it with after-tax money, if tax rates do go up, if you get a nice return of 7%, and if you hold on to the Roth long enough, once you start taking income out of it and do not have a tax liability, you may come out well ahead. And it doesn't work the same for everybody. And, you know, the better the rate of return gets, the more favorable it is to the Roth, because you're leveraging that higher growth in a tax-free bucket. So there's lots that goes into that. This is our Roth calculator. The other observation you can make from this is that it's not a life-changing amount. I mean, over the rest of your life, to make another $220,000 on an investment that is now worth $584 when you're only in your 50s, it's not life-changing. So most of these Roth calculations are not so extreme that it's shining the light brightly on a Roth conversion. Usually it's better, and you got to wait a long time for that to mature, but it's better. And that's where some of these non-mathematical elements come in. How are you going to use it? When are you going to use it? And if any part of your strategy has to do with passing on benefits to the next generation. So that's a little bit about our Roth calculator. We've been unsuccessful at pulling clients through that calculation with having them kind of turn their head around, but it's, you know, there are a lot of influences. So let's just finish up with talking about, if you are going to engage in conversions, what are some of the strategies? What are some of the ways that people arrive at the calculation to figure out how much conversion they're going to do? Some of these terms I just made up because it sounded right. But the first would be, and Dave, do you see this?
Yep.
All right. So the first would just be the a la carte method. How much can you afford? So I'll have a client that says, look, I just got a windfall. I got about $50,000 that I didn't expect to have. How much Roth conversion can we do wherein the tax bill will come out at $50,000? Whatever that number is, that's the conversion I want because I want to spend this investment of 50 to pay for that Roth conversion so my life can be better. So that's the a la carte approach. Just what can you afford? Chunking is based on the tax brackets. Again, saying, look, I'm at 120,000, and if I go over 178 or whatever it was, I'm going to jump 8 points in tax brackets. So let's do a Roth conversion that keeps me under that next vivid jump in tax brackets. So that would be chunking. Another approach is serial Roth conversions, where you just say, look, I can't afford, I'm about to retire next year. I have a golden parachute. I have deferred comp money coming out. I've got to exercise my stock grants. So I can't do it this year. And I really can't do it next year, but I don't want to wait forever, particularly if the market's down. So you just say, I'll take $200,000 of my traditional IRA, and I'll do $40,000 of Roth conversions over 5 years. You just spread it out. So that keeps the tax burden low, and you can work with your CPA to make sure that that fits in with the tax bracket maximization. The situational approach is very reasonable. That's just, you do it when circumstances tell you it's a good time to do it. So the market gets clobbered. We covered that. You take that depreciated IRA, move it over to the Roth because you know that the market's going to have a V-shaped recovery, and you want the regrowth and future growth to be on the tax-free side. Another situation, you separate from service. So you're at your highest earnings year as an executive of Citizens Bank, and you retire, and your compensation starts 6 months in the new year. So you do a little Roth conversion in the latter half of that year, and then you do a big conversion the first full year when you're not working, and you go back down to a much more humble tax bracket. Or you start to find out that on the legislative calendar, the tax rates may indeed go up, and you want to get ahead of it. So there are all these different situational reasons why you could do a Roth on the fly if your circumstances dictate that you should. And then I just put in here the last one, the January effect, and I kind of covered that, but I want to tell you an interesting story because we have a CPA colleague who has a client who did a conversion the first week of January. The person knew that the taxes wouldn't be owed until the following April. So that's 14 months of a honeymoon. So he took the money after he converted it. He speculated on a biotech stock that he had some familiarity with. The thing went through the roof from that January to the following April, and it grew so much that he actually did cash out some of the IRA to pay the taxes that he owed in April, and the remainder stayed in there and was tax-free, and much more than he would have had he not done it. I've even heard examples of people who buy a house in their IRA, flip it, and then cash out a little bit of the cash part of the IRA to pay the tax bill. So there are some kind of cute situational things you can do with Roth conversions. We're not advocating flipping biotech, but this person was in the industry. So. All right, and I'll finish up with just more organic other Roth funding methodologies that aren't necessarily conversions. And the first and most important is that almost everybody who's in a 401k, or almost every 401k, and in some cases, I'm going to stick my neck out and say some 403bs for the nonprofit industry, they have a Roth election. So if you're putting 20,000 in the pre-tax part of your 401k, you might be better off splitting it and putting 10 into the pre-tax and 10 into the Roth. because the Roth contributions in a 401k are not subject to income limitations. And I'll tell you what I mean by that. So again, it's, do you want to pay tax on the seed or on the harvest? Or rather, do you want to avoid tax on the seed or the harvest? And it is great to maximize your 401k and knock out some of your tax liabilities, but then the year turns over and turns over again and you forget about it. You might be better off foregoing some of that tax break and just accumulating a ton of Roth money. And further, some firms, my son's law firm has what they call excess contributions, where you can put in more than the statutory limit. You don't get a deduction for it, but after you put that excess contribution in, you can do an in-plan conversion to Roth. So if you have a 401k and you don't really know what Roth opportunities exist, first, find out if you can make Roth contributions and then call us back. And secondly, check out and see if they have in-plan Roth conversions. I will tell you that the Joe Biden plan is trying to crush in-plan Roth conversions. The last one is really meant for our younger clients to a degree, but not always. And we've been doing a lot of this for some of the children of the folks that are on this presentation with us. And it's the best thing that we could do for them. And that's called backdoor Roth IRAs. How does that work? If you're a single person and you're young, you're in your first job, you're crushing it, you're making good money, and your income, your modified adjusted gross income is over 140,000, then you're ineligible to make a Roth IRA contribution. You just can't do it. So you can just march on and try to build your Roth assets through your company plan, or you could circle back and do what they call a backdoor Roth IRA, which also may go away, but you never know. They threaten it every year. This is the way it works. You put $6,000 in a traditional IRA. There are no income limits that prevent you from doing an IRA, but you just can't deduct it. So you're earning 140, you can't do a Roth, you can't deduct an IRA contribution, but you can make one. You do it after tax. So you put $6,000 into the traditional Roth, you don't deduct it, and the day after the check clears, you convert that money to a Roth account because there are no limits on conversion. The only tax that you pay is tax on the amount that IRA gained in value. But if you put the IRA non-deductible into the account on a Tuesday and convert it to a Roth on a Wednesday, you haven't made any gains. Therefore, none of it is taxable. They call that a backdoor Roth IRA, and it is awesome. The key to this is that it becomes very difficult if you have other IRA accounts, a big rollover IRA, a SEP IRA, because some of that other IRA balance gets pulled into the taxability. So it really only works if you don't have other IRA accounts. And just to show you an example of something creative, one of our very high net worth clients had a lot of assets in his company retirement plan, but he only had a smaller IRA. And he really loved the idea of backdoor Roth IRAs, but he didn't want to catch any of his existing IRA into that calculation. So he rolled his IRA into his 401k so that it was still growing in a tax shelter. Now he didn't have any IRAs, and we've gone through a series of backdoor Roth IRAs for all the years since. So it's kind of a cool thing that you can do. If you have a monster rollover IRA from former employers, you're probably not going to be doing backdoor Roths. But this is a great gift to make for your children or to convince your children to do Roths. And if they're overachieving as single people and making over 140 as a young 28-year-old, man, the backdoor Roth IRA is a great turbo boost to what they're doing on the corporate side. So Roth 401ks, backdoor IRAs are other methods to achieve a higher Roth position. So that's it.